the aftermath, and what's ahead for precious metals. 3 days ago, silver was sitting at $34. Today, it's bleeding. Portfolios wiped. Confidence shattered. But here's what nobody's telling you. This crash wasn't random. It was engineered. And the same people who triggered it are now quietly loading up. What do they know? That you don't? Stay with me, because by the end of this video, you'll understand exactly why this crash might be the biggest opportunity of 2025. Welcome back to Currency Archive. Now, if you've been with us for a while, you already know we don't do panic here, we do clarity. But if you're new and you found this video searching for answers, do me a small favor. The subscribe button, it's right there. Think of it like bookmarking wisdom. You wouldn't throw away a good newspaper before finishing the article, would you? Same thing, subscribe. So you never miss what matters. And while you're at it, drop a comment. Tell me, where in the world are you watching from right now? On Thursday, January 30th, 2026, silver investors around the world woke up to what many believed would be another day of celebration. The white metal had been on a historic tear. Prices had climbed past $100 an ounce. Portfolios were green. Social media was euphoric. And then the floor disappeared. Within hours, silver futures plummeted 31%. It was the worst single-day decline since March 1980. The iShares Silver Trust ETF collapsed by a similar margin. ProShares, Ultra Silver, a leveraged fund favored by aggressive speculators, cratered more than 60% in a single session. What had taken months to build was erased in minutes. The question serious investors must now ask is not simply what happened, but how. The sequence began not with a fundamental shift in supply or demand, but with a piece of political news. Early Friday morning in Asia, reports emerged that President Trump would nominate Kevin Warsh as the next Federal Reserve Chair. Markets interpreted Warsh as a hawkish choice, a policymaker likely to prioritize inflation control over accommodation. The dollar surged, and precious metals, priced in dollars, began their descent. But the political catalyst was merely the spark. The fuel had been accumulating for months. Throughout 2025, silver had risen more than 135%. In January 2026 alone, prices climbed another 60%. Technical indicators flashed warnings that few wanted to acknowledge. The relative strength index for silver had entered extreme overbought territory. Speculative positioning had reached levels not seen in decades. The market was stretched thin, held aloft by leverage and momentum rather than fundamentals. When the first wave of selling hit, it triggered a cascade. The CME Group, which operates the COMEX futures exchange, had seen this building. In the weeks prior, the exchange had begun raising margin requirements the cash collateral traders must post to maintain their positions. On December 26, 2025, maintenance margins for March 2026 silver contracts increased from approximately $22,000 to $25,000 per contract. The market shrugged it off. Prices continued climbing toward the $120 mark. By January 28th, the CME shifted to an entirely new system, moving from flat dollar margins to percentage-based requirements. Initial margins rose to 15% of contract value for standard positions and 16.5% for accounts deemed high risk. For traders controlling 5,000-ounce contracts, this meant posting significantly more capital or facing forced liquidation. When the political news hit and prices began falling, the margin calls came fast. Traders who could not meet the new requirements had their positions automatically closed. Each forced sale pushed prices lower. Each price drop triggered more margin calls. The feedback loop accelerated until the collapse became self-reinforcing. By the close of trading on January 30th, COMEX February silver futures settled down 31.35% at $78.29 per ounce. It was the largest single-day closing decline since 1980, when regulators used the same mechanism, margin hikes, to break the Hunt brothers' legendary silver corner. The parallels to 1980 are instructive but incomplete. In that era, the Hunt brothers had attempted to corner the physical silver market, accumulating vast quantities of bullion while simultaneously building enormous futures positions. When regulators raised margins, the brothers could not meet the calls. Their empire collapsed, and silver entered a 20-year bear market. But 2026 is different. The Hunt brothers were speculators seeking to manipulate price. Today's market is defined by something far more structural, genuine industrial demand colliding with constrained supply. What made January 30th particularly revealing was what happened outside the COMEX. While paper silver was crashing in New York, physical premiums in Shanghai and Dubai actually surged, trading as much as $20 above Western spot prices. The disconnect between paper markets and physical reality had never been more visible. The aftermath left a trail of destruction. Mining stocks collapsed in sympathy. Newmont, Barrick Gold, and Agnico Eagle each fell more than 10%. Coeur Mining dropped nearly 19% intraday. An estimated $1 billion in leveraged positions were liquidated across precious metals in a single session. Group chats went silent. The loudest voices stopped posting. Portfolios that had doubled in value over the previous year were cut in half within hours. But for those watching closely, the crash revealed something the headlines missed entirely. The selling was mechanical, not fundamental. The liquidation was forced, not voluntary. And the institutions that triggered the collapse were not running from silver. They were quietly preparing to buy it. There's a question that separates casual observers from serious analysts. When a market moves violently, who benefits? On January 30th, 2026, millions of retail investors watched their silver holdings evaporate. They saw red numbers, they felt panic, they sold. But somewhere else, in quiet offices far from the chaos, a different conversation was taking place. Not about losses, about opportunity. The crash did not happen to the system. The crash was the system, functioning exactly as designed. To understand who architected the collapse, one must first understand the structure of the silver market itself. Unlike stocks, which trade on transparent exchanges with publicly disclosed ownership, the silver futures market operates through a small network of institutions known as clearing members. These are the largest banks and trading houses in the world. They do not simply participate in the market. They are the market. They provide liquidity. They set prices. And critically, they hold the largest concentrated short positions. For years, analysts have tracked commitment of traders reports released by the Commodity Futures Trading Commission. These reports reveal positioning data for commercial traders, the category that includes bullion banks. In the weeks leading up to the January crash, the data showed something unusual. Commercial short positions had expanded dramatically even as prices climbed. The banks were not hedging existing inventory. They were actively betting against the rally. When prices were rising, these positions represented billions in unrealized losses. The banks faced a choice: cover their shorts at catastrophic expense, or find a way to bring prices down. The margin hikes provided the mechanism. The CME Group is not a regulatory body. It is a publicly traded corporation. Its primary obligation is to shareholders, not to market participants. When the exchange raises margin requirements, it does so to protect its clearinghouse from counterparty risk. But the effect of those decisions is never neutral. Higher margins disproportionately impact smaller traders. Retail investors and independent speculators operating with limited capital are forced to liquidate first. Institutional players with deep balance sheets and direct credit lines can absorb the increased requirements. They can wait. They can even add to positions as prices fall. This asymmetry is not accidental. It is architectural. Consider the timeline. On December 26, 2025, the CME raised margins for the first time. Prices continued climbing. On January 13th, the exchange shifted to percentage-based margins, a structural change that would automatically increase collateral requirements as prices rose. On January 28th, margins were hiked again. 2 days later, silver crashed 31%. 5 margin increases in 35 days, each one tight at noose, a little tighter, each one forcing more weak hands to capitulate. The pattern is identical to 2011, when 5 margin hikes in 9 days broke silver's rally toward $50. It is identical to 1980, when the COMEX changed its rules mid-game to destroy the Hunt brothers. The mechanism never changes, only the names on the losing side. But the margin hikes alone do not explain the full picture. The timing of the crash coincided with another event that received far less attention in Western media. On January 1st, 2026, China implemented new export licensing requirements for critical minerals, including silver. The policy effectively restricted the flow of refined silver out of the country, impacting approximately 70% of global supply. This was not a minor adjustment. China is the world's largest processor of silver. Its refineries handle ore from mines across Asia, Africa, and South America. When Beijing tightened export controls, it did not merely reduce supply. It fractured the global market into 2 separate pricing regimes: the paper price set in New York and London, and the physical price emerging in Shanghai and Dubai. While COMEX silver was crashing towards $78, physical silver in Eastern markets was trading at premiums of $15 to $20 above spot. Industrial buyers in Asia, desperate for actual metal, were paying prices that Western charts did not reflect. The banks that held concentrated short positions on COMEX were not exposed to this physical premium. Their obligations could be settled in cash at the paper price they had helped engineer downward. The transfer of wealth was neither random nor democratic. Retail traders who had chased the rally with leveraged futures positions were liquidated at the worst possible moment. Their losses became realized. Their metal, if they held any, was shaken loose. Meanwhile, commercial traders with the deepest pockets and the most information quietly covered short positions at prices 30% below the highs. This is not conspiracy. This is market structure. The rules are public. The data is available. But understanding requires looking beyond the price chart to the hands that move it. The same institutions that triggered the crash are now accumulating at prices they helped create, and they are not finished. There's a number that Wall Street does not want investors to understand. 528 million ounces. That is the volume of paper silver exposure currently held against just 113 million ounces of registered physical metal in COMEX vaults. For every single ounce of real silver available for delivery, nearly 5 ounces of paper promises exist. This is not a market. This is a confidence game. And on January 30th, 2026, the confidence began to crack. For decades, the price of silver has been determined not by the metal itself, but by contracts representing the metal. Futures, options, ETF shares, synthetic instruments layered upon synthetic instruments, each one creating the illusion of silver ownership without requiring the inconvenience of actual silver. The system functioned as long as nobody asked for delivery. As long as traders were content to settle in cash, the paper price could diverge from physical reality without consequence. The exchanges could print as many contracts as the market demanded. The bullion banks could sell silver they did not possess. And the price discovery mechanism could be controlled by those with the largest balance sheets rather than those with the most metal. But something changed in 2025. Industrial users stopped accepting paper. The shift began quietly in the solar manufacturing sector. Every photovoltaic panel requires approximately 20 grams of silver. As global solar installations accelerated, manufacturers found themselves competing for a metal that was already in structural deficit. The silver market had run supply shortfalls for 5 consecutive years. Annual mine production had declined 7% from its 2016 peak, despite prices more than doubling. And unlike other commodities, silver could not be quickly ramped up. 60% of global supply comes as a byproduct of copper, lead, and zinc mining. Dedicated silver mines are rare, underfunded, and years away from bringing new production online. When China restricted silver exports in January 2026, the supply squeeze became acute. Manufacturers could no longer rely on spot market purchases to meet production schedules. They needed guaranteed metal, not paper contracts that might settle in cash. The response was unprecedented. Technology giants began bypassing exchanges entirely. Samsung secured exclusive rights to 100% of output from a Mexican silver mine for 2 years through a direct prepayment agreement. Tesla, according to industry reports, authorized procurement teams to pay premiums as high as $500 per ounce in extreme scenarios, rather than risk production line shutdowns. These were not speculative trades. These were survival strategies. The divergence between paper and physical prices became impossible to ignore. On the morning of January 30th, while COMEX futures were collapsing towards $78, physical silver in Shanghai traded at $93. In Dubai, dealers quoted premiums of $20 above London spot. In Mumbai, retail buyers paid the equivalent of over $100 per ounce for physical bars and coins. 2 markets, 2 prices, 1 metal. The implications are profound. For over 40 years, the COMEX has served as the global benchmark for silver pricing. Mining contracts reference it. Industrial purchase agreements are indexed to it. Central bank reserves are valued against it. But if the paper price no longer reflects physical availability, what exactly is the COMEX pricing? The registered inventory numbers tell a story that headlines ignore. COMEX registered silver, the metal actually available for delivery against futures contracts, has fallen to historic lows. Meanwhile, open interest, the total number of outstanding contracts, remains elevated. The ratio between paper claims and deliverable metal has reached levels that market veterans describe as structurally unsustainable. In a normally functioning market, arbitrage would close this gap. Traders would buy cheap paper, take delivery, and sell the physical at higher prices in Asia. The price difference would narrow. Supply would flow toward demand. But the arbitrage mechanism is broken. Taking delivery from COMEX requires navigating a bureaucratic maze of warrants, vault transfers, and shipping logistics that can take months. By the time a trader extracts physical metal from the system, the opportunity has vanished. Meanwhile, those selling paper silver face no such constraints. Contracts can be created instantaneously. Positions can be rolled indefinitely. The asymmetry favors those who deal in promises over those who seek reality. The crash of January 30th did not resolve this divergence. It amplified it. Paper silver fell 31%. Physical premiums in the East barely moved. The gap between what the screen says and what the metal costs has never been wider. For investors who understand this distinction, the implications are not bearish. They are historic. Every crisis carries a lesson. Most investors learn it too late. The lesson of January 30th, 2026 is not that silver failed. It is not that precious metals are finished. It is not that the skeptics were right all along. The lesson is simpler and far more dangerous to ignore. Price and value are not the same thing. They never have been. And in the months ahead, That distinction will determine who builds wealth and who surrenders it. The Federal Reserve now faces a decision that will shape markets for years. Kevin Warsh, Trump's nominee for Fed chair, is perceived as hawkish. Markets interpreted his nomination as a signal that interest rates will remain elevated, that inflation control will take priority over accommodation, and that the dollar will strengthen against alternatives. This interpretation triggered the precious metal sell-off, but perception and reality often diverge. The United States carries $36 trillion in federal debt. Interest payments now exceed the defense budget. The government must refinance trillions in maturing obligations at rates far higher than when that debt was originally issued. The mathematical pressure for lower rates is not political, it is existential. Warsh may speak of discipline, but the bond market will demand relief. And when that relief comes, whether through rate cuts, balance sheet expansion, or creative mechanisms yet unnamed, hard assets will respond. The crash of January 30th did not change this trajectory. It created a reset point for those paying attention. The supply picture has not improved. It has deteriorated. Fresnillo, the world's largest primary silver producer, cut its 2026 output guidance to between 42 and 46 million ounces, down from earlier projections of 45 to 51 million. The company cited declining ore grades and operational challenges. This is not a temporary setback. It is a structural reality facing the entire industry. Global silver mine production peaked in 2016 at 900 million ounces. Despite prices more than doubling since then, output in 2025 reached only 835 million ounces. The reason is geological, not financial. After decades of extraction, the easy silver is gone. Average ore grades at the world's largest mines have fallen 36% over the past decade. To produce the same amount of metal, miners must now process 50% more rock than they did 10 years ago. New projects cannot fill the gap quickly. The development timeline from discovery to production spans 7 to 10 years. Permits must be secured, infrastructure must be built, capital must be raised. Even if silver prices doubled tomorrow, meaningful new supply would not arrive until the early 2030s. Meanwhile, industrial demand continues accelerating. Solar installations consumed over 200 million ounces in 2025. Electric vehicles added another 50 million. Data centers, semiconductors, and artificial intelligence infrastructure require silver for thermal conductivity and electrical connections. This demand is not speculative, it is contractual. Production lines cannot run without the metal. The mathematics are unforgiving. Consumption exceeds production. Inventories are depleting. And the price correction of January 30th did nothing to alter these fundamentals. For the business community, the strategic implications are clear. Those who sold during the crash converted temporary paper losses into permanent wealth destruction. They exchanged a tangible asset with declining supply for currency that central banks can create without limit. They made the same mistake that has impoverished investors during every monetary transition in history. Those who held maintained their position in an asset that industrial civilization cannot function without, and those who understood the mechanics of the crash recognized January 30th not as a defeat, but as an invitation. The institutions that engineered the sell-off through margin hikes and coordinated pressure are now accumulating at lower prices. Commitment of traders' data in the coming weeks will reveal the shift. Commercial short positions will decline. Managed money will rotate from short to long. The same players who profited from the descent will position for the ascent. This is not speculation. This is pattern recognition. The playbook has been used before. In 1980, in 2011, in 2020. Each time, the crash created the conditions for the next advance. The question is no longer whether silver will recover. The question is who will own it when it does. Paper traders who panicked have already provided their answer. Industrial buyers securing physical supply have provided theirs. Central banks diversifying reserves have made their choice. Technology companies locking in mine output for years ahead have placed their bets. The crash was not an ending, it was a transfer, and those who understand what just happened will not be victims of the next correction. They will be its beneficiaries.